Hello, welcome back to this week's market update. Today is Monday, September 15th, 2025, and we will jump right in. Equities ended the week on a strong note as tame inflationary data, particularly on the producer side, along with weakening labor market indicators, reinforced expectations for a rate cut this week. The Nasdaq Composite led with over a 2% gain last week, followed by the S&P 500 up more than 1.5%, and then the Dow Jones Industrial Average up just shy of 1% as of close on Friday last week. Heading into our economic data from last week, we did get both the Consumer Price Index and the Producer Price Index. CPI coming in pretty much in line with expectations at an annual rate of 2.9% on this headline basis here. It was up about 0.4% month over month, and core prices up about 3.1% and up 0.3% on a monthly basis. So we do see a bit of a trend up in consumer inflation, but it did come in line with expectations, which was appreciated by the market last week. Looking at some of the categories within the CPI, what was driving it, you can see here that food inflation did pick up a bit in the month of August to 2.7%. Food prices rose actually 0.6% in just the month of August, so that was kind of a inflationary hotspot there for the month. Energy prices overall pretty neutral from a year ago, up 0.2%. You can see we have a lot of weakness in energy commodities, gasoline, oil, while energy services like electricity and gas services were both up quite a bit from a year ago, overall leading to a pretty neutral state compared to August of 2024. We saw new vehicles up a pretty small 0.7%, which is really unique given that new vehicles imported are subject to tariffs, so we haven't really seen the inflationary pressures there. However, we have seen inflationary pressures on used vehicles, which were up 6% from a year ago, so pretty unique dynamic there. And then lastly, looking at shelter, this has cooled to 3.6% annual inflation there, which is moving in a positive direction. It was kind of stuck near the 4% inflation rate. It's been slowly ticking down as we see some weakness in the housing market as well. Now, looking at our producer prices, our wholesale inflation, our PPI here, we did actually get overall deflation on this headline number in the month of August. So prices actually fell 0.1% from July to August. This was largely driven by lower energy costs as well as a sharp decline in trade service cost here. So overall, those two categories were really the only thing driving this deflation in the month. You can see other categories like foods, that was up just a minor 0.1%, other services up 0.3%, transportation and warehousing up a bit of a hotter 0.9% in the month here. Other goods prices also up just 0.1% in the month of August. So definitely some positives here, but we do think that this softer energy pricing, softer trade service costs, that really led to this decline, which may not be sustainable since these are two very volatile categories. Shifting gears into some more labor market focused data here, we did get some pretty sharp downward revisions to job gains figures, and this was for the period before March of 2025, so not necessarily too deep into 2025 here. It showed that employment was 911,000 jobs fewer than initially reported. And revisions are pretty typical of these different economic data points, but revisions of this magnitude are not very typical. So that is why this was a pretty negative economic indicator last week. We also see a lot of weakness bleeding into this year. You can see this summer, the average job gain was just 29,000 jobs. Typically, on average, this number is between 100,000 to 200,000 jobs added per month. So averaging just 29,000 is very low there. And you can see we actually had jobs declining on a net decline in the month of June. So pretty negative data point here. But again, the market took it as another reason for the Fed to cut rates this week, which would be a positive outcome. On top of those pretty sharp revisions, we also got initial claims trending up in the data released last week. Jobless claims rose to 263,000 for the week ending September 6th. This was the highest level since October 2021, when the labor market was still recovering from the pandemic. So the pickup in claims, as well as those pretty sharp downward revisions, continues to add to evidence of a cooling labor market and will definitely be factored into this week's Federal Reserve meeting and their policy decisions. Also here we got the index of consumer sentiment from the University of Michigan. This continues to be a pretty weak spot of economic data as well. You can see the index in September was down nearly 5% month over month, down 21% from a year ago. Much of this is driven by consumer expectations, which are down 30.4% from a year ago, down 7.3% in just 1 month there. This was largely driven by lower and middle income consumers, with a lot of expectations for higher unemployment over the coming year weighing on this confidence. So we saw that in the data points getting revised lower. Consumers are really feeling it, the weakness in the labor market. People are taking longer time to find a job. Employees are staying longer in their jobs because they don't have as much confidence that they can job hop around. So that all coinciding with this weaker consumer sentiment data. Last but not least, we have the market probabilities of a rate cut this week. So on Wednesday, the Fed will meet and announce any changes to monetary policy as well as their summary of economic projections, their forward-looking outlook. Right now, the probabilities stand at just above a 94% chance of a quarter percentage point cut and a 5.6% chance of a jumbo 50 basis point rate cut on Wednesday. So definitely looking to be a pretty certain outcome. Obviously, we won't know for sure until Wednesday, but the market is pretty much expecting that 25 basis point rate cut. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.